Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I just got back from the Options Industry Council conference this year. And one of the major themes that we saw was just the proliferation of shorter dated expiration strategies that retail traders are predominantly driving. The number of option contracts, even though we have close to 1.7 million option series that are available for trading, nearly half of the trading volume in the US are on option contracts that expire in less than 7 days. A lot of that is concentrated in the most liquid names that have 0 days to expirations listed on them or weekly options listed on them, such as Tesla, Apple, SPY, QQQ, SPX, these types of contracts that have very short dated options. And NASDAQ as an exchange just filed for a commentary period to potentially start listing 0 days to expiration strategies on some of the major tech stocks. So Tesla, Apple, Facebook, or Meta, these types of names, Amazon, to be able to offer 0 days to expiration strategies on single stock. Currently, we only have 0 days to expiration on index and ETF options. But like I said, it seems like the direction that the market is heading in are shorter dated expirations available on more products. So what I want to do is I want to take a bit of time here, given the popularity of these types of these contracts, the popularity from retail traders to trade these. I wanted to do a session where we can look into those further, better understand these types of products before you go ahead and trade them. And more importantly, look at quantifying the 2 most important Greeks that you need to understand in order to trade these products. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll use as example purposes during today's session. So my goal is to provide you with the foundational knowledge to understand shorter dated 0 days to expiration options. Now, I'm going to be using 0 days to expirations for my examples, but the same principles that I'm going to discuss will be applicable for those of you that are trading weekly options. So let's say you trade 7 days to expiration options, or let's say you're trading them on Tesla and you're trading the weekly ones. So let's say you're just selling premium on weekly Tesla options, or you're buying short dated options on stocks that you think are going to move, let's say on earnings. The same things will apply for a 7-day option, but I'm going to use 0 days expiration to just show you the difference between a longer dated option versus a shorter dated option and help you better understand, what are the differences. We'll look at kind of how 0 days expiration differ from longer dated ones, and then we'll look at specifically buying versus selling. What are the pros and cons of buying versus selling those specific strategies? Now, today's recording and slides will be available for those of you that have a free trial or an account at OptionsPlay.com. Just simply sign up for the free trial using the QR code on your screen, or go to OptionsPlay.com/signup. A free 30-day trial will give you access to all the tools that we offer here at OptionsPlay, as well as a notification when we post these recordings available with the slides so that you can follow along at your own pace. But I'll try to keep things fairly straightforward and simple for today's session. Really, what we're going to go over are 2 of the most important Greeks if you are trading these shorter dated expirations, and that's theta and gamma. So let's look at theta. What does theta mean? Why do we need to know it if we're trading shorter dated expirations? Theta represents, in theory, how much an options premium may decay each day with all factors remaining the same. Meaning, if you hold an option contract and you hold it for 1 day, how much does the value of that option decrease by holding that option for 1 day? Because Options have extrinsic value. That extrinsic value always goes to zero at expiration. So every single day you hold on to an option, the extrinsic value of an option, if all things else held equal, will decrease. And what we're trying to measure is how much does that decrease? Because if you're a buyer of an option, that decrease is working against you. Right? That's the time value that's always working against you as a buyer of an option. So you're always working against the clock as a buyer. Now, if you're selling an option, that erosion in value is working in your favor. There are other things working against you as an option seller, but the theta is the one thing that's working against you. So you have to basically understand how much premium are you losing that day versus how much can you potentially gain elsewhere that can offset what you're losing on that given day. So that in a nutshell is why theta is so important. And theta, as many of you may know, accelerates as you get closer and closer to expiration. But what we really want to get an understanding of is how much of acceleration do you have in theta, and what is the actual impact that it has on you as a trader when theta accelerates in those last few days versus if you were to sell or buy a longer dated option. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. So, when we think about the shelling, when we think about trading any of these shorter dated expirations, and I'll cover the range anywhere from 0 to 7 days out as what I would consider shorter dated expirations. Theta, as we just said previously, is the change in value of an option with respect to time, and that time decay that occurs as an option approaches expiration. That theta decay happens faster and faster as you approach expiration. Generally speaking, a 0 days to expiration will only collect about 1/8 of the income versus a 45 days to expiration option. And we'll take a look at kind of what that means, and specifically when you're selling shorter dated options, how come you get more income per day with higher risk and higher transaction costs? Okay, so let's take a look at an example of this. This we're starting out with is a 30-day option. So this was pulled just about an hour before we started when SPY is trading at 588. So right around the 588 mark. And what we're going to look at is buying a 30-day, which is the June 13th expiration. We're going to look at the June 13th 588 call, which are highlighted by the red dotted line at the bottom of your screen. As you can see, that's currently trading around $11.58. It's got a theta of 18.5 cents. And so what that means is that for this option that we've purchased, okay, or let's say we were to purchase this option, for this option that we've purchased, the option price is around $11.58. I'm saying that there's 1 cent in intrinsic value because the stock is currently trading at 588 and 1 penny versus the strike price is a 588 strike. So it has 1 cent in intrinsic value and $11.57 of extrinsic value. Now, remember, if everything else stays constant, meaning nothing about the stock price changes, volatility doesn't change, and the only thing that changes is that we move forward in time, the theta is telling us that for holding on to this option contract for 1 day, meaning holding it from 30 days expiration to 29 days expiration, we would lose 19 cents out of the $11.58 that the option is worth today. Or to be more accurate, we're losing 19 cents out of the $11.57 because that's the extrinsic value of the option. We're losing 19 cents out of $11.57. So let's just put that into perspective. 19 divided by 11.57. Whoops. 19 divided by 11.57. That's 1.6% of the value of the option that you're losing on that day for holding it for 1 day. Okay. You're losing 1.6% of the option that you are either purchasing or selling for that 1 day that you're holding on to it, if all things are held equal. Okay, so now let's take a look at that same example using a 0 days to expiration, right? So this is I took this when SPY is trading at basically the exact same price, 588 and 2 cents, and then I'm looking at selling the May 13th expiration, which is the expiration that expires today. And what you see here is that Oh, whoops. Anyway, let's look at the box here on the bottom, on the bottom right, okay, on the 0 days to expiration option. So that option is currently priced at $1.23. There's about 2 cents of intrinsic value, so the extrinsic value is $1.21. And if you look at theta, it's saying that it's 1.17. So basically, you're losing effectively the entire value of the option at expiration. And that makes sense, right? Because the extrinsic value of an option goes to 0 at expiration. So you effectively lose 100% of what you lose. You're paying 100% of the premium that you can in extrinsic value that will basically evaporate to 0 at the end of the day, right? So again, as an option buyer, you need to have this the value of that option increase by $1.17 to $1.23 before the end of the day, just the break even, meaning the stock has to move in this particular case over $1.23 in your favor in order to offset what you're going to lose in time value. And as an option seller, you're going to gain about $1.17 to $1.23 before the end of the day, if all things else are held equal. And what that means is that you have to believe that the stock is not going to move by more than $1.23 before the end of the day in order for you to turn a profit on that particular trade. But basically, the difference is that you're going from losing 1.6% of the value per day, or gaining 1.6% of the value per day if you're trading a 30-day option, now to effectively gaining or losing 100% of the value of the option using a shorter dated option. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Now, keep in mind that this is very theoretical in nature from the perspective of this is saying if all things else are held constant, right? Meaning the stock doesn't move, there's no news that comes out, there's no changes in implied volatility, everything else held constant. The only thing that changes is you go from now to expiration and everything else stays constant. These are the things that affect the value of your option and how much they affect it by. But that's not the real world. So in order to better understand the real world, we have to understand the second Greek, which is gamma. So when we look at gamma, gamma represents the rate of change between an option's delta and the underlying asset price. Now, I'm assuming that most people here have a basic understanding of delta. And what delta is basically the sensitivity of your option price to the sensitivity to the changes in the stock's price. So if the stock goes up by $1, how much does your option go up by? If the stock goes down by $1, how much does your how much does your option contract go down by? So that's delta. But the problem with delta is that delta is not static. Meaning, if let's say you have a delta of 50 cents and the stock moves up by $1, the delta doesn't stay at 50 cents, right? So if the stock goes up $1 and then another dollar and another dollar, every time it goes up one more dollar, the delta will actually change. It doesn't stay constant at just 50 cents if you have a 50 delta call option that you purchased. What gamma does is it shows you how much delta will change by as the price of the stock changes. So delta is not static, it's dynamic, and gamma helps you measure how dynamic delta is. So this is an important concept to understand because as you trade 0 days to expiration options, just like how theta goes on steroids when you're trading shorter dated options, as we saw before in the previous example, when you're trading option contracts that are approaching expiration, I would argue that gamma risk is actually something that is less understood and arguably more important for those of you that are trading shorter dated options. Because as we said, gamma measures the change in delta with respect to changing underlying, but 0 days to expirations are very, very sensitive to small changes in the underlying. So small changes in the underlying will cause big, big swings in the delta of an option. Meaning a small change in the underlying price will have a much larger effect on the value of your option when you're trading shorter dated options than if you're trading longer dated options. So what we really want to talk about are, the differences between buying versus selling options from a gamma perspective, and then understanding just the magnitude between selling longer dated versus shorter dated options. So let's take a look at gamma first on a 30-day option. So same example before, we're looking at the SPY was trading at 588. We're looking at the 588 strike call option. We're looking at buying let's say the 30-day at the money 588 strike on SPY. And you can see before we were saying that the mid price on that is $11.58 with 1 cent in intrinsic value, $11.57 of extrinsic value. And what you see here is a gamma of 0.01. And what that tells me is that, and also the other thing you have to see is the delta here is 0.51, right? So what that tells me is that if the value of SPY were to go up by $1, then what I have to factor into is delta and gamma. So what this is telling me is that if the stock goes up by 1 penny, by $1, my option contract from a delta perspective will go up by 51 cents, right? So for every $1 the stock goes up by, the option contract will gain 51 cents. But because gamma is also 0.1, what I have to factor that into is that basically I'll earn 1 extra cent on that $1 move. So instead of earning 51 cents on that move, my $1 move will contribute to a 52-cent change in the underlying price. Okay, so let's just kind of do a little bit of math too. 52 cents on $11.50, let's call it $11.58. That means for a $1 move in the underlying in SPY. So SPY goes from 588 to 589. I'm going to earn about a 4.4% increase in the value of my call option. Or if let's say I sold this call option, I would lose 4.4% of my options value for a $1 move in SPY. Does that make sense, everyone? Please type 2 into the chat window. I'm sorry, please type 3 into the chat window if that makes sense to you. So again, in this example, when we're talking about gamma, we're saying all things else held constant. The only thing that's changing is the stock price is moving up by $1. Okay, if it moves up by $1, my option contract will gain 52 cents, 51 cents from delta, 1 cent from gamma, and that equates to about a 4.4% return on the option contract that I either bought or sold. Okay. So now let's take the same example and look at a 0 days to expiration. So same example, stock trading at 588 and 2 cents. I'm looking at buying the 0 days to expiration at the money call option. And as you can see, that option costs $1.22, as we said before. And the gamma here is 0.13 with the same delta of 0.51. Okay, so let's look at the same two scenarios. One person bought the 30-day at the money call option. One person bought the 0 days to expiration at the money call option. One person paid $11.58. One person paid $1.22 for the 0 days to expiration. So if the SPY were to gain by $1 over between now and the expiration date of the contract, or rather, if it gained $1 effectively right now with all things else held constant, you would earn 51 cents from delta, right? Because delta tells you the sensitivity of an option relative to the change in the stock price. And then you would have to add another 13 cents on top of that for gamma. So that's at 51 cents plus 31 cents is 82 cents. I'm sorry, 51 plus 13 is 64 cents. So for this option contract, it'll go from $1.22 plus the 64 cents will go to $1.86, right? So 64 divided by 122 is a 52% gain or loss on the trade, depending on whether you're buying or selling the option. So in the 30-day example, we said that you had about a 4.4% gain or loss for a $1 move. When you're trading the 0 days to expiration, you had about a 52% gain. So 52, and these are very rough numbers, but 52 divided by, it was actually 52.4, just to be more exact, divided by 4.4, you basically have the zero days to expiration providing 11.9% more leverage than the 30-day option. So what we're learning here is what is the difference in terms of time decay, right? Whether you're buying or selling, and what is the difference in terms of a leverage that you're getting between a 30-day and 0 days to expiration option. So let's just go back and review real quick. In this example, we lost about 4.4% of the, sorry, was it 4.4%? What is 19 divided by $11.58? It was 1.6% of the stock's value. So let's just let's do a little bit of math here again. Okay, so when we were looking at the 0 days expiration versus 30 days expiration from a theta perspective, theta accelerated about 62 times more on the 0 days expiration than the 30-day option. So as a seller, you're going to gain theta 62 times faster than if you were to sell a 30-day option. Now, as a buyer, that obviously works against you. On the vice versa, when you're trading these shorter dated expirations, you are going to get a roughly 12x more leverage on a shorter dated option versus a longer dated option. So those are the two factors that you have to think about, right? Because as an option buyer, you want more leverage, right? The more leverage, the better, right? Because if the stock goes in your favor, you can make a much bigger gain. But as an option buyer, you get this huge acceleration in theta that's going to work against you, right? So you have to find the balance between, do I want to be a buyer and have lots of leverage when I'm trading shorter dated options and have a huge amount of theta decay on the back end of that I have to manage from a timing perspective? Or do I prefer to be an option seller and have a huge amount of time decay, but also have this huge amount of leverage that is potentially going to work against me if the directional view is wrong, right? Because if I get this huge acceleration in time decay by selling shorter dated options, I'm taking on 12 times the amount of risk than if I were to sell a 30-day option. Is that worth it? Is the acceleration in time decay worth 12 times the added risk that I'm taking by selling on 0 days to expiration versus a 30 days to expiration? Now, that is a question that I can't answer for you because every single viewer here has a different risk profile in terms of what your preferences are, in terms of the risk profile that you're looking for. Are you looking for high risk, high reward? Are you looking for a steady income? What's your preferences? Those are the things that's going to help you answer the question. And keep in mind, what I'm only giving you are two discrete points that are sort of at the extreme ends of the spectrum, right? One is 0 and one is 30, but there's plenty of expirations in between, right? And I would say that probably for the vast majority of viewers here today, you might find yourself leaning towards one end of the spectrum, but you have a lot of choices in between. You don't have to just choose 0 or 30 days. You can choose a 7-day option or a 14-day option or a 21-day option, where you kind of are again on a spectrum and you're just trying to figure out where on that spectrum you want to fall. But what this helps you understand are what do the extremes look like and what are the differences, so that I can figure out on that spectrum where I would want to be. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Someone asked me, where does the 4.4 came from? So 4.4 was referring to how much could I make if in this example, if I bought a 30-day option, a $588, $588 strike when the stock's trading at 588, and SPY went from 588 to 589, so it moved up by $1. We said that you would gain 51 cents from delta and 1 cent from gamma. That's a total of 52 cents, right? And the option costs $11.58. So if you take 52 cents and divide it by $11.58 is what I purchased, you would get 4.4, or more accurately, 4.5%. So you get a 4.5% return on your investment if you were to be a buyer of this option, or 4.4% loss if you were to sell, if you were a seller of that call option. So that's where the 4.5% number came from. Okay. All right. Hopefully that kind of breaks down these types of these strategies. So then let's take a look at just buying. Let's kind of review what we've learned so far, right? Buying options. So most days lack a strong direction. You know, what I just said to you, basically, if you want to boil it down, is that buying an option has a ton of leverage, but sorry, when I'm talking about buying shorter dated options, it has a ton of leverage, but it also has a ton of time decay on the back end of it, which makes timing on these incredibly sensitive, meaning the difference between buying at, let's say, the open and closing at 10:30 a.m. versus, let's say, buying at the open and closing at 11:30 a.m. Those two differences will have a very big difference in, or very big impact on your P&L, because of just that 1 hour will eat, you know, somewhere between 10 to 15%, probably closer to 15 to 20% of the value of your option, just by holding on to an additional hour. So incredibly sensitive. So what you need to do is, if you're going to be buying shorter dated options, you only want to buy them when you expect the stock to make a big move in a short amount of time. And, you know, I've hosted separate webinars on the different indicators that we use to try to gauge when those days are going to happen. Like I said, they only happen about 15% of the days. So this is a strategy that you have to be incredibly patient for, where you know that 8 to 9 days out of the week, that you're 8 to 9 out of 10 days that you're trying to buy a short dated option, you're going to end up walking away not buying anything. Which might be frustrating, but that's why I think it's also important to understand buying versus selling, so that you can sort of combine those two strategies. On some days, or most days, you end up selling, and then on the infrequent days where you do get those big moves, that's when you turn into a buyer and you try to hit some home runs. But this is a strategy that you need to stay extremely disciplined, because, like I said, very few days are suitable for buying options, shorter dated options. There are a few days where you can really hit some big home runs, but it's really important that you're patient and you understand both, because you don't want to sit there 9 out of 10 days not trading at all, just staring at the screens. And that's where I think selling options, adding up a selling option strategy on top of that, is something that you might want to consider, because when you're selling options, bullish strategies tend to statistically be more favorable, just because markets move higher 60% of the time, they move lower 40% of the time. Now, many of you are likely going to want to be tactical and say, you know, some days I want to sell options but be more bullish. Other days I want to sell options and be a little bit more bearish. And there's nothing wrong with that. But just statistically speaking, you definitely want to understand that there is a advantage to selling bullish premium than there is to selling bearish premium. Generally speaking, you either want to stay with strategies that have limited risk, such as credit spreads, for those of you that have smaller accounts, for those of you that have perhaps a slightly lower risk tolerance, selling shorter dated credit spreads, or any type of defined risk strategies such as butterflies or even iron condors. Those are the types of strategies you want to trade. But for those of you that are more purist in terms of option selling, selling strangles and straddles are going to yield you the best results from an option selling strategy. And that comes from the fact that you're collecting premium on both sides. So you're collecting double the amount of theta. And generally speaking, Vega is not too big of a concern, because you're only selling it over 1 days. Vega, and if you're holding it closer to expiration, Vega is not really big of a concern. And in most instances, will actually work in your favor. So because you have double the amount of theta working in your favor, you know, that increase in leverage that I was talking about before gets minimized a little bit. Minimized is probably not the right word. It gets buffered a little bit, because time decay is working in your favor while gamma is working against you, right? And we talked about the fact that you get 62 times more leverage in a you get 12 times more leverage buying a shorter dated option than a longer dated option. So that 12 times more leverage is working against you as an option seller. But when you're selling strangles and straddles, the extra premium will provide an additional buffer against that 12 times leverage that's working against you. So for those purists, selling strangles and straddles will be the best performing option selling strategy for 0 days expiration. But for a lot of beginners, for a lot of traders who have smaller accounts, defined risk strategy just makes more sense than selling something that has theoretically unlimited risk, even though that unlimited risk is over a 1 days to expiration is pretty small relative to the quote unquote unlimited risk nature of this specific strategy. And you can always look at kind of some worst case scenarios, like for example, what happens if you sold a short dated strangle right before April 2nd this year? What would have been your outcome on this specific strategy? And I think what would surprise a lot of traders is, the loss that you experience on April 2nd would obviously be a fairly sizable loss. No doubt about that. However, if you stuck to that strategy on April 3rd, April 4th, April 5th, April 6th, and you kept doing it, one, you would find that the recovery back to break even is one of the fastest of any option selling strategy. Especially as you sold the next few days when things started to calm down, when volatility started to come in a little bit, you would have been able to, number one, collect a sizable amount of premium that would get you back to break even incredibly fast, even though those are probably the scariest times to continue selling strangles. And that's psychologically something that a lot of traders kind of struggle with, right? Is that, you sold the strangle, you lost a ton of money one day. How do you get back in the next day and do the exact same thing? But in reality, that is actually what gets you back to break even the fastest, is you have to continue selling strangles when that vol is jacked up on the days like April 3rd, April 4th, April 5th, because that's going to get yourself back to break even. But a lot of traders who are new to these types of strategies, the second you have a big loss on a short strangle, you pull back. You stop selling strangles. You're concerned that you're going to have another bad day. And sometimes you do have 2-3 bad days in a row. But those 2-3 bad days in a row are typically followed by 2, 3, 4, 5, 6 really great days on the back of that will offset the losses that you experience in those first 3 days. Very difficult to learn, because emotionally speaking, like I said, once you take that big loss, a lot of people pull back on their risk tolerance, and that is actually what causes this strategy to underperform. And then as an option selling, if you're selling option strategies, you always want to close it out before noon, around noon or 1 p.m. at the latest. These are not types of strategies that you generally want to hold into expiration, right? So if you sold a strangle at 9 a.m. or sorry, 9:30 a.m. or 10 a.m., you want to hold it for those 2-3 hours, collect the time premium, and then not have the gamma risk going into the close. That is also what has been back tested to be more successful than selling one of these strangles and holding it all the way through expiration. So what you're doing is you're capturing that accelerated time premium on a part of the day. And, especially between 10 to 12, that tends to be a quieter time in the markets. You tend to have smaller moves in the market so that when you close it out by 12 p.m., we tend to see bigger swings going into the close. When you're playing around 12 times more leverage with a shorter dated option than a longer dated option, that 12 times leverage can really hurt you as an option seller going into the close. So that's why most option selling strategies for 0 days to expiration, most traders will close those out a few hours before the close to avoid that closing auction that sometimes can swing prices substantially in just the last few minutes. Okay, so the high level, let's just review some of the things that we said, okay? when we're talking about theta, time decay, you get a huge acceleration as you get closer and closer to expiration. And when we looked at the difference between a 30-day versus a 0-day expiration, we saw 62 times more of an effect of the value of the change in the value of your option on a 0-day expiration versus a 30-day expiration. So theta is a very important component in understanding the difference between buying versus selling, longer dated versus shorter dated options. And then gamma, which is the other, which is the sensitivity of the option to the changes in the underlying. Time and changes in the underlying are the two biggest components that will affect the value of your option. With the 0-day expiration, we saw that you had about 12 times more leverage trading the 0-day expiration versus the 30-day expiration. So these two factors, as you can see, they're kind of two factors that get put on steroids as you get closer and closer to expiration. And these two factors are largely work against each other, right? So when you're a buyer, theta is working against you, leverage is working in your favor. As an option seller, theta is working in your favor, but leverage is working against you. So it's just important to understand that as you get closer and closer to expiration, or as you choose expirations that are closer to zero, you get increases in gamma and you get increases in theta. And hopefully what I provided you with today with these examples is a way to just understand and quantify how big of a difference is there in terms of the acceleration in theta, and how big of a difference is there in terms of the leverage that you're getting. And it's your role to think about that and pick an expiration date that suits your risk tolerance. I think that for many traders, 30 days to expiration might be sufficient, but there are lots of other traders that want more leverage, want more risk to reward. And you know, you might never go down to 0 days to expiration, but maybe you might find your sweet spot is at 14 days or 7 days. And this is meant to help you understand where on that spectrum you should sit. This is not necessarily recommending that you trade 0 days to expiration. 0 days to expiration is just the other end of the extreme. And I think if we explore both ends of the extreme, we can then better understand where on that spectrum we should sit. Okay, so with that, that covers what I wanted to share with you here today. Like I said, this was meant to be short and sweet, giving you a better understanding of these types of concepts so that you can make better decisions for yourself. So before I open this up for Q&A, if you want access to today's slides or today's recording, if you already have an account with OptionsPlay or a free trial, you'll get an email from us later this week with that recording with the slides. But if you're brand new to OptionsPlay and you want access to these as well, alongside our OptionsPlay platform, which will give you daily trading signals, our weekly research report that gives you our equity research ideas for the week, and access to the full platform. You can sign up for your free 30-day trial with your QR code on your screen, or go to optionsplay.com/sign-up. Okay, so let's take a look at questions. There's a Q&A window and there's a chat window. If you don't mind, try to point your questions into the Q&A window, and I will try to answer as many questions as I can. Does theta change intraday on 0 days to expiration? Theta always changes, right? And it changes substantially as you get closer and closer to expiration as well, because the extrinsic value of the option is going to change so much in that last day. So, you know, this example that I gave you, right? Let's go back to this. Where is this? So I go back to this example, this one. So, you know, when I bought, if you were to buy that 123 option, you know, you have a theta of $1.17. You know, if the value of the stock goes down by, let's say, $1, you know, that theta is going to decrease from $1.17 probably down to 20 cents, right? So huge changes in theta intraday as well, because the extrinsic value of the option changes so much with gamma. When actively trading, what does your daily routine consist of? I guess active trading is a pretty wide spectrum, right? If you're talking about active trading in terms of day trading, that's very different than active trading as someone who's, swing trading but executing trades on a daily basis. So if you don't mind clarifying that, I'm happy to try to help you understand. Regardless, either one, you need a routine, right? Swing trading is a very different routine than someone who's day trading. Day trading, you have to be far more disciplined from a risk management perspective, on a minute to minute basis versus swing trading, you need to be more active on a risk management perspective on a daily basis. I would say that's probably the biggest difference, just compression in terms of time frame. But the role that you take as a trader is the same whether you're trading intraday or swing trading, but you're doing it every day. Yes, recording will be available in the email. Is gamma exposure along with call and put wall levels useful for trading 0 days to expiration? If so, how can they be efficiently used in such strategies? Yeah, so gamma exposure is something that's a relatively new concept that's come into play in the last, call it 4 or 5 years, where exchanges are now selling some proprietary data that allows people to calculate how much gamma exposure market makers have. Because there are hundreds of thousands and millions of contracts of SPX options contracts that are bought and sold, SPY option contracts that are bought or sold, and every single time someone buys and sells them, if there's any type of imbalance in terms of net deltas on the market maker's side, they have to hedge that delta risk by buying or shorting the S&P 500. They'll do it either through stock, they'll do it through futures, they'll do it through a number of vehicles. But when the gamma exposure gets large enough, the market makers, the amount that they have to hedge their exposure with is sometimes large enough to move the markets. And what that does is that has an influence on where SPY ends up closing on the day. I'm just explaining gamma exposure to those of you who may not know. Many of you may actually be subscribed to a service that maybe provides gamma exposure. But what it does is it tells you where market makers, potentially have exposure, as it approaches expiration, and if they need to be buyers or sellers of SPX or futures in order to reduce their exposure. And what that gives you a good sense for are, it doesn't necessarily tell you where it's going to go, but if the S&P 500 moves to a certain level, what is likely going to be how the market reacts to those levels? Are market makers going to sell into those levels, or they need to buy as they reach those levels? So it's a bit of an art versus a science. But there are services out there that provide this type of information. They're suitable for day traders. They're suitable for traders who are selling, or buying 0 days to expiration options. But they're really only suitable for traders that are trading very short dated intraday stuff. They're not particularly useful for swing traders. Are we able to practice these trades in our OptionsPlay paper trading portfolio? You absolutely are. You can pull up an OptionsPlay platform. Give me 1 second just to do that real quick, and I'll show you how you can do that. I'll come back to this once I get the OptionsPlay platform up and running. What does buying gamma mean? You're not buying gamma. What you're doing is you're either long or short gamma. And you're long or short gamma. If you're long an option, you're long gamma. If you're short an option, you're short gamma. Meaning gamma is going to either work in your favor or it's going to work against you, depending on whether you're a buyer or a seller. You don't actually buy gamma per se. You're buying a call or a put that has a specific amount of gamma exposure. Thank you, Mario, for the kind words. I really appreciate that. Do you have examples of entry and exit trades that left a profit and one that left a loss? I'm not entirely sure the question here, what you mean here, but I'll try to answer that question. Give me 1 second. Let me pull up the platform just so I can show this to you. I'm just pulling up a few different options so I can show it to you guys. Okay, all right, let's take a look at these. Right, so you guys should be able to see my OptionsPlay platform now. And what I have are three options. I have the 0 days to expiration 590 call, the 1 week 590 call, and then the 30-day 590 call. So the same strike price, same different expiration dates. One is 0 days, one is 7 days, and one is 31 days to expiration. And try to answer a couple of questions at the same time. There were questions about, can I paper trade these? You absolutely can. You can click on the trade button. You can either you can trade this into either your TradeStation simulated account if you have a TradeStation account, or you can simulate this into an OptionsPlay paper trading portfolio. So you can create as many portfolios as you would like within OptionsPlay. So I have one here called paper trading portfolio. I'm going to select that. In this particular case, I'm buying the May 13th 590 call for 24 cents. If I add that position, it will then show up in my portfolio here within OptionsPlay here on the upper left-hand corner. If I click on portfolio, I will be able to see that within my paper trading portfolio, and I can select which portfolios I want to see. So let's just look at my paper trading portfolio here 1 second. I have 3 positions, and here's my SPY position, the May 13th 590 call, and I can track that in my paper trading portfolio. As it approaches expiration, it'll show me my P&L, how much I'm making or losing on that specific trade, and you can do it for any type of strategy, 0 days to expiration, 7 days to expiration, whatever expiration makes the most sense for you. Okay, let's take a look at the rest of the Q&A questions. I was in and closed. I was in and out of and closed an SPY SSS this morning. I'm not sure what an SSS is. That a short? I'm not sure what an SSS is, so if anyone can clarify that for me, that'd be great. But would you ever do another of this later in the day? Generally speaking, one, I'm presuming this is a short strategy, meaning you were selling an option. And generally speaking, if you were to make a profitable trade on a short option strategy, especially for 0 days expiration, I would not try to do it again later in the day, because later in the day, the theta and gamma acceleration just even gets further compressed in the further in the day. The closer you get to expiration, you effectively approach infinity on both theta and gamma as you approach expiration. So generally speaking, the rule of thumb is, close out the trade by noon, don't get back in. Have you quantified that really realized volatility has been fairly elevated versus implied? I don't have the tools, but it seems to me it's the case for around a month. So the question is, in the past month, has realized volatility been higher than implied volatility? Now, that should be fairly easy to find out. There are many services that provide historical versus implied volatility. And you can just graph the two. One, typically speaking, implied volatility is higher than realized volatility. But if you're suggesting that you think realized volatility has been higher than implied volatility, I'd have to look into it, but it's not hard to find out. I've heard some folks losing millions selling 0 days to expiration on tracks and SPY in just 1 day. So why do people take that much risk? Please advise. I really can't answer that question. Why do people go to casinos and gamble away $1 million in a night? I really don't know how to answer that question. Different people have different risk tolerance. Different people have different amounts of money they're willing to risk on a trade. And some people are risking it without understanding those risks. And that's what I'm hoping to avoid here, is to help you understand those risks so that you can make informed decisions and risk the appropriate amount for your portfolio. What platform would you recommend? So, I'm not necessarily recommending this particular platform. I'm just telling you what platform I've been trading on for 18 years, and that's Thinkorswim. Um, I don't, I think there are plenty of platforms that offer very similar functionality, but the one functionality that I find on Thinkorswim that doesn't, that I I'm not saying it doesn't exist out there, but it's not particularly common, and it's one that I use very often, especially with options trading, trading complex options, is the ability to put in a bracket order on a complex option strategy. So putting a limit and a stop order on a credit spread, a debit spread, something you can't do on all platforms. And it's an incredibly powerful feature that I use all the time, and that's why I continue to use Thinkorswim. How does VIX affect the theta and gamma? So VIX will affect theta from the perspective of, as VIX is higher, the option premiums will be higher. So you have higher theta. Does it affect gamma? It has a negligible effect on gamma. It doesn't have much of an effect on gamma. So much bigger effect on theta, negligible effect on gamma. Um, a straddle strangle swap. Um, So the strangle swap, right? You're meant to. That's slightly different from the perspective of because you are hedged with the long strangle. Yeah, sorry. I'm presuming you're short the strangle and long the straddle, but you're delta hedge in that scenario, which does make it a potential candidate to potentially sell another straddle strangle swap if you are trading that strategy. That is a strategy that is very much in the deep end of the pool, not particularly suitable for most traders here. It's actually a pretty interesting strategy for those of you that have a basic understanding of straddles and strangles to take advantage, because it doesn't have the same risks as selling a naked straddle or strangle. It's actually two diagonals. You could actually think of it as two diagonals that you're trading, which both have limited risk. Um, but in that particular example, that is a strategy that you could sell another one of later in the day. Um, Someone's asking about the earnings navigator. The earnings navigator comes out once a week, just to clarify, not twice a week. It comes out once a week on Friday afternoons, and we email it to all of our members. So you don't get it on the platform at the moment. We are working on it so that it's available to you on the platform as well. In your vast experience, how much money should someone start trading with 0 days expiration options? Well, one thing with 0 days expiration options is that these are day trades, right? So from a pattern day trading rule perspective, you need $25,000 to do this. You don't want to get locked out, after doing this for 3, 4, 5 days. So minimum you need is $25,000. With that covers what I wanted to share with you here today. I hope that this is helpful and illuminating just how big of an exposure, a change in exposure you get when you go from 30 days to 0 days to expiration from a theta and gamma perspective. And by exploring kind of the two ends of the spectrum, it'll help you understand where on that spectrum you want to be. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.